Welcome everyone to LeapMeet number 93, January 2023 trade log review and technical analysis. We'll try to make it as quick as possible, but feel free to answer or ask any questions that you might have. Put it in the chat or just unmute yourself and ask it. It's fine. No need to wait until the end of the meeting to ask your questions. If something I'm saying confuses you or you have any follow-up questions, just go ahead and ask me, okay? All right, so let's get started with January 2023 trade log. This last month was quite interesting, as you all know. We saw quite a bit, as you can see. Let's take a real quick look here. So January is pretty much started right here. And the entire month, as you can see in the hindsight, it's pretty straight. Everything moved up. But if you were in the trenches and if you're trading and if you were actually going through the day by day, it wasn't as simple as it looks on the chart. And that's usually the reality of it. And that's why looking back at the chart is good. But at the same time, you want to be able to recognize this pattern while it's happening. That's why I've been sharing trades of what I'm seeing, what I do on my chart, how I make certain decisions. Like we have been following channels for past couple of days, if you guys know, and I have explained every single trade that were possible, as well as we could have taken. But that's the real-time trading. But when you're looking back at the chart, which I call hindsight trading, things seems very simple. Looking at it, you would be like, oh, okay, it was moving sideways and started moving up, and once it broke over this level, all you have to do is stay in it, and it would have been worked out. I would have made this much money or that much money. But that's not the case. Like, for example, let's just say it started here for first 3 days. It was sideways, moved up on day 5th on January. It moved up and then sell off entire day. So when that kind of price action happens, and then the same thing happened on Thursday, you would expect market to roll over. But instead, it started moving up the next day again. And then we saw 3 big red candles. At that point, you have to have your guards up that if it breaks the 388 level, it is possible that it could go down. But instead, market continued to bounce back up, went to the highs from the previous week, and then continued to move up. Also, last month was quite tricky in terms of inflation data, FOMC meetings that were happening. So a lot of things were going on. But overall, market bounced back nicely. Now we are here. So very tricky month indeed, but in hindsight, it's moving up. It's moving up nicely. So let's go back to the trade log. And as you can see, the first week was very, very good for us. We took about 22 trades, 2 losses. One of the loss was pretty much, I would consider it lotto. One of the SPX trade actually, and other loss was Microsoft, where we actually followed the stop losses and got out of it with about 25% loss. Few good 100% play. We weren't able to take out full advantage of this Tesla trade. As you can see, our first exit was around break even. And that's what we use for our calculation for like profit and loss, because if you were to have $700 position, you would get out on first or second exit. You wouldn't wait until our third or fourth exit. Those exits are for the people who has bigger account. Like myself, I trade usually multiple number of contracts depending on the price, but usually it's like triple digit. So I can afford to take 2, 3, 4 exits. But if you're trading with $700, you're probably going to get out right away. And that's what we put when we calculate the profit and loss for the month. So this P&L, I mean, sorry, this P&L usually use the first and second exit, because one of the things that we try to do at TRADEORE is show you the realistic picture. We don't want to give you something or tell you something like, oh, trading is easy. All you got to do is this or that, or it doesn't work that way. In real life scenario, you would not have waited until 131%. That was our last exit. In real life scenario, you would have gotten out with me at 220 when we got out first. So that's what we do, try to do here, make it as realistic as possible. But even then, it was a very, very good week. And then come week 2, this is where things started getting a little bit ugly. On the chart, if you see, this was the, when did the, sorry, 9th is when the second week started. So if you look at here, it started right here. So it moved up, very, very good. It was continuation from this move up. So we thought it's going to continue to move up. It didn't, it pulled back. And then when we decided to change our bias to moving down on the puts or bearish bias, it started moving up. So a little bit of choppy to start the week. And so the first day, calls, puts, all worked out great. Only one small loss in Netflix, nothing major. The second day, same thing happened. We entered in Tesla. Things were choppy. We decided to stay put. And there will be days like this where you will take maybe 1 trade, 2 trade, or no trade at all. And that's okay. You do not have to trade every day to be a profitable trader. This is something that most people don't realize it. You should only be trading when you have an edge in the market. Take last 3 days, for example. We took so many trades. Every single trade worked out. Maybe 1 loss or 2 losses here and there, but almost every other trade worked out for us. And why? Because there was volatility in the market, there was a nice range in the market, and there were trends, there were directions, everything was working out. That was a good trading environment. But when market is moving sideways, there is no range, there is no clear direction. It's moving up and then down and then up and down and then up and a little bit and then down again. It is overall, it is moving up or it is moving down, but it's super choppy movement. That is not a very, very, that is not a trader-friendly environment. And you shouldn't be trading or forcing trades just for the sake of it. Always try and take trades only when you have certain edge in the market. Because remember, in the stock market, in the sea of stock market, you and I are small fishes. You are probably like the smallest one. Because I've been here for about 13 years trading and all that, I'm maybe a little bit bigger, but there are sharks. There are whales. Those fishes are out there to get me. And the only way we are going to survive is by being very, very careful about what we are doing, when we are doing it, and what is the market conditions and what you're seeing on the chart. So only by being super careful, you will be able to survive for years to come. If your attitude is that I'm just gonna go take 2 trades every day, make $500 a trade, and then I'll be out and I'll make this much money at the end of the month, and I'll make this much money at the end of it, you are going to get slaughtered. You are going to get eaten by those big sharks, because they know a lot of things that you and I don't know. They know the market makers, they know the news that's coming out before you and I do. They have already positioned themselves to take advantage of interest rate decision. All these things that are secret to us and unknown to us, they already know. That's why all this all this US lawmakers make so much money because they already know what laws are coming, what's in the pipeline, what's good for business, what's bad for business, what's good for stock market. They don't know all that. Those are sharks. We're not sharks. So what we need to do is be careful. That's my point. So when the days are like that, you get out. We took one trade and I pretty much sold most of my position, break even. I wasn't gonna bother trading when market is nothing, like it's not in your favor, right? And then the next day we tried taking 4 trades. Out of those 4, 3 didn't work. A bad day. Market was choppy, as you can see from one of the notes. So, and this is why TradeLog is important, because you can go back and see what mistakes you have made, why certain things didn't work, what worked. When I first started it, I would log every single trade at the end of the day. That was my routine. Market closes, I stay put, I log every single trade that I took, every single trade that I missed, why I missed it, why I took it, why it worked, why it didn't work. I take extensive notes. If you see my trade logs from probably like when I started it 7-8 years ago, every single trade would have a note attached to it. Like, why did I decide to enter Netflix? Oh, it was break over this certain level. Oh, it was break out of downtrending channel. It was break below uptrending channel. Whatever the reason was, I would write it down. At the end of the month, I would tell you like, okay, which pattern is working out the best for me? What's not working? And the simplest thing you can do to be a better trader is do more of what's working and less of what's not working. The only way you will be able to do it is by having a trade log. Because at the end of the month, if you go back, first of all, you're not going to have anything to go back to, because you're not going to remember every single trade that you took. You probably don't remember your trades from last week, do you? Nobody does. We're not superhuman. That's why we take notes. But at the end of the day, when you go there and now you have extensive notes in front of you, what you got to do is you got to sort through it and be like, okay, what is working for me? What is not working for me? This pattern has worked like 8 out of 10 times. Good, I'm going to continue doing this. This pattern hasn't worked that well for me. I took 4 trades following this pattern. All 4 failed, 3 failed, whatever it is. So I need to do less of this. You need to start putting time in. And this is the preparation that you do that will help you get better. Not following me, not doing what I do, not reading the commentary, not watching videos, none of that will help you as much as doing this will help you. So do this. That's what I keep telling everybody. People do it for maybe a week and then they get lazy because it's a lot of work. But if you're serious about trading, it's not. Right? So anyway, going back to this, bad day, stop loss trigger the first time, we took some loss. The second time, market was very choppy on this day, took some dips. So this tells me that I should have cut down on my trades. Market was already choppy and I keep trying to take trades on it. So took small loss again, choppy market, wasn't doing anything at all beside eating the premiums away because it was moving sideways. Shouldn't have traded. One trade barely worked. That was Tesla and it was all right. So bad day overall. And then the next day we bounced back, and that's what we do. Like one bad day, one bad week, even one bad month, even one bad year doesn't define you. Like when you are looking at a bigger picture as a trader, like what is your game? You need to ask yourself, like, why am I trading? And how long do I see myself trading? If your answer is that I'm trading because I want to be a good trader, I want to use this profession to give me some flexibility in my time, and make me reach whatever that may be, right? You need to ask yourself, why am I doing this? And what's the reason I'm doing this? And once you know how long you want to do, like for me, when I started it, my goal was to be so good at it that I don't have to have any other job. And I wanted to be able to travel. I wanted to be able to live good life, own fancy cars. So in order to do all that, I had to play years game. I wasn't playing months. I wasn't playing weeks. In my mind, I'm going to be doing this for next 25, 30, 40, 50 years until I die, pretty much. Because this you can do from the wheelchair once you're old and wrinkly, right? So my goal was that big. So when I think about it for next 40 years of my life and trading and doing something that will truly make me happy and help me achieve all my goals, then when I have one bad day, one bad week, I have had bad years. Like I've had in the beginning, I've had bad years where I lost so much money, and even at that time, I'm like, okay, what's your goal? What's your plan? Like, do you really want to do this for next 40 years? Then don't let one bad year stop you from going after what you really want to do. Don't let two bad years stop you from going what you want to do. So when it comes to one bad day, one bad week, one bad month, it doesn't matter at all to me. Like you just bounce back. You just focus on the next day. You just focus on the next week. You just focus on the next month, because that's how you're going to move forward. Nobody's perfect. Even the greatest of the greatest sports player have bad days, bad week. You're Indian, you all know Virat Kohli, so you know the patch that he just went through, and now he's bouncing back. Everybody has bad days. You will too, and I have had my share of bad days, bad week, all of that. So, point is, you bounce back. So the next day we bounce back, couple of monsters, 100% plus trades. Every single trade worked out. The same thing followed. Then the day after that, we took multiple green trades. Overall, we bounced back, but it was a very, very challenging week when you go back and look at it. Good thing though was that we followed our stop losses, so this could have been a lot worse if we did it. If we were to take 100% losses, so if I were to just do say like 0, so this 249, if I were to do 0 here, it will turn into 489. If I were to do 0 here, that 75 would turn into 500. If I were to do 0 here and let it all go to 100%, this would have been 600. This would have been a really, really, really bad day. Because we still follow the stop losses, it wasn't as bad as it could have been. And this is why following stop losses is so important. But then again, it's not as simple as it sounds. Like I can just tell you, like, follow your stop losses, but then where do you put stop losses? Why do you stop out from some trades and not the others? Because things are different for every single trade. It's not as simple. Days are different. The trading environment is different. So, and especially options move so fast. So for example, if something is going down and you see violent, like the overall daily trend is downside, and then out of nowhere, you see it go up like for 15 minutes straight up. At that time, your thought process is different. You are thinking that because it's moving down pretty much entire day, this is a random bounce and it is going to continue to come back down. And maybe 6 out of 10 times you are right, but the other 4 times you're wrong. So how do these do the stop losses? That's for you to figure out. That's for you to understand from can you guys see my screen?
Yeah.
Okay. Okay, yeah, sorry. I'm gonna go back. So that's for you to figure out based on your position size and your account size. So a lot of time when I let something go to zero, it's because I already, like, if you look at the alerts that I'm posting, usually I post like smaller size. Sometimes I don't post smaller size, meaning that I'm going all in, or I'm in all in, meaning that I'm taking the full position. But sometimes when I post smaller sizes because I'm not too confident in where the market is going. It is giving me indication. It is giving me, I am going to try taking advantage, but I wanted to contain my risk to minimum just in case I'm wrong, right? So when you do that, I'm already, like, for example, if my usual position size is $1,000 per position. For when I say small size, I'm already cutting it in half. So my position size is $500. So at that point, I'm already putting stop losses built into my position. So even if that particular position goes to zero, 100% loss, comparing to my original position size, it's only 50% of that. So it's kind of similar to what I would have done if I were to have $1,000 position. If I were to have $1,000 position, I would have stopped out around 50% because that's my maximum loss I'm willing to take on $1,000 position. By cutting my position size in half, I'm putting that stop loss built in. So if that half position goes to zero, I'm still losing only 50% of what I my 50% of my original position size. I hope that's making sense. But that's why I would let it go to zero, because it's already built in for me. That is my maximum loss I'm willing to take on any position whatsoever. So if I were to be $1,000, I would have stopped out at 50%. If it were to be $500, I would have let it go to zero. So that's my plan. That's how I trade. You need to figure out what works for you and your position size, and how do you trade. So for example, if your maximum position size is $500, and you usually take about 3 or 4 contracts of like $1, and if you have taken already, for example, on this day, if you have taken 2 trades already and both of them are down, don't open third position, because it's already, you're already down. You, at that point, you're revenge trading. You're trying to figure out how it's going to get better. How can I recover this money or that money that I have lost? So that's not a good thing to do. The other thing that you can do is basically half your original position size. So if your original position size is 500, maybe take 1 contract or 2 contracts. At that point, you're only losing $100, $200, right? So that you can make it back with 1 good trade, and it's just that simple. But all this stuff, I get asked a lot, like, how do I do the stop losses? Like, it doesn't make sense. Sometimes it go to zero, sometimes. So this is how you need to figure it out. It's never straight answer. I still struggle with it. I still stop out, and one of the main things people say is that, oh, I stopped out on my position, I followed my stop losses, and then it bounced back and went to 100%. That happens to me too. That happens to everybody, right? So what's most important thing for you to do is follow your trade plan. And that's the best thing any of us can do. And this one thing that I tell every single person who has talked to me is that you don't get lucky. You do not plan for this big number that you see here, 120%, 115%. You don't plan for that. It just happened. If you're meticulous, and if you're disciplined, and if you follow your stop losses, if you follow your trade plans, there will come a day where you will make 100% plus trades. It's not going to happen if you plan for it, because nobody can plan for it. I don't plan for it. Any of these big numbers that you see, 100%, 300%, whatever, this 400%, most of the time, like 9 out of 10 times, or 99, 98 out of 100 times, My first exit is always around 20 to 30%, always, because that is my trade plan. And then market surprises me because I was disciplined, because I followed my trade plan, because I did what I supposed to do. It surprises me and it rewards me, and it continued to push higher, and I continue to take more and more and more and more profit. But if you try and plan for those 100%, you will lose a lot of gains. You will lose a lot of profit, and your profitable trades will start turning into negative trades and losses, because this number is easy to achieve in options. This number is also easy to achieve, but about 80% of the time, it will not get there. And you know it. We stopped out at a lot of these numbers, and you have seen it happening again. Like, how many times our position went to 30%, we took first exit, and then the last exit was at a break-even point, stop loss at break-even. How many times that has happened? Now imagine every single trade, every single one of those trades, your plan was to wait for 40% or 50%, all those trades would have been losses. If I didn't exit at 23%, at 11%, at 6%, 13%, 22%, 6%, 22%, if I didn't do this exits, if I didn't take this profit, all this trade would have been red, all of them. You take profit consistently, aim for 20 to 30% consistently, and there will be days where you get lucky. There will be days where you blink an eye and it will be at 100% or 200%. There will be days, but those days are rare, and you get lucky. Those are luck-based trades. This is what you plan for, and this is what you aim for. You don't aim for this numbers. You aim for this numbers, and once you start getting this numbers, numbers will start to come. So don't get cocky, don't get greedy. Oh, I'm only trading for 20%. When you were trading stocks, 20% when you're trading equity stocks is almost unheard of. It happens rarely, right? So aim for these numbers, make a plan, and based on those plans, you can use your stop losses. Anyway, moving forward. Sorry for going on this tangent, but it's very important for you guys to understand how to achieve that mindset where your trade log looks like this. And in order for your trade log to look like this is the important column that you need to understand, and you need to pretty much make your singular focus this column, not this column, not this one or anything else. This column, first exit, profit loss, 20 to 30%. If you focus on this, I promise you will be successful. Anyway, week 3, another fantastic week. We took a lot of trades, about 22 trades. This one went all the way to $1 the next day. We stopped out about 28 cents. We followed our stop losses. It was Monday, so I was in a full position, as you can see. So I wasn't going to I wasn't going to wait around and find out why I wasn't going to wait around and find out if it would bounce next day or not. If it reaches my point, I'm out. I'm just following my stoppers, and I'm going to stop here for a minute. There is a question. Usually it's in my mind. So for example, I entered in a position, it's a 20% down. I don't bother putting manual stop losses at that point, enter the stop loss order. I'm just monitoring it. Like in my initial days, I only open one position at a time, or maybe two. So it's easy for me to monitor those two stocks and two of my position. At that point, that's all I'm doing. I don't focus on anything else, what anyone else is doing, all other names, what market is doing. I do not care. If I'm in Tesla and Amazon, my singular focus is on Tesla and Amazon. That's it. I don't care about anything. So the point is, I'm focused there. So I know when it's time to get out. So I don't need to enter manual trades in it. If you are multitasking, for example, if you're trading and then now you are at your office working on something, it makes sense to put your stop losses and then go do something else or focus on something else. But if you're watching screen, if you're following your trades, if you're following the names that you're in, it's okay to not put stop losses, just monitor it. So you need to you need to do what's good for you, right? So if you're a full-time trader, then it's okay. You can slide by not doing any manual stop losses in place. But if you are multitasking, like I was in the beginning, where I had a day job and I was trading, and a lot of time after first 2 hours of trading, I would go to my day job. At that time, I would put my stop losses in there just in case it hits that point. So you need to do what works best for you. But those are the two ways you can think about it. You're welcome. All right, so move on. So, and then the SPX trade went to zero. Google 40 cents. I had half position, went to zero, and then this was Lotto same day trade, obviously. So that went to zero as well. But at the same time, we took some good Lotto trades that day. This was, I believe, the day after Netflix reported its earning, and we got in a little bit too early. So there we go. So that's the mistake that I made that day. Everything else was according to plan, worked fantastic. NVIDIA, we absolutely nailed it that day, and it all worked. So 22 trades for the week, 4 losing trades. Week 4 was the week before last, and great 29 trades. That was another week where we were following the path like charts, and there were range all week. Market was moving fantastically, and we took full advantage of it. We made some pretty great trades. A couple of trades didn't work out, though. On Monday we only opened one because, again, market was very choppy that day. So the only trade we took that day was SPX, and that was it. And then the next day things started moving. We started taking some trades, making some profits. Still, there were times where I wasn't confident in the position, so we just scaled out really fast. Wasn't going to wait around and find out what happens to this position. Eventually, it would have worked out. But again, following the plan is more important than potential profit. And then the same thing continued the next week, and Monday, Tuesday last week, we still had pretty good trades. Well, this SPX went on 200%, and overall, pretty great month. 99 total trades, 85 wins, 14 losses, 85.85% success rate. We had about 1,100% plus trades, which is also another fantastic. Total SPX trades based on the TRADEORE AI that I'm working on: 34, 29 wins, 5 losses, 85%, and 14% losses. So great month, even better for learning, getting experience. These are the months where you, like in the beginning of the month, market was like in the middle of the month, market was choppy, hard to trade. It turns easier. And as you can see, we are taking more and more trades every day because market is giving us more and more opportunities. But then there are days like this, or 2 weeks ago, where we are only taking 1 trade a day, or 3 at most, like things like that. And that is okay. You need to take what market gives you. You cannot argue with market. You cannot force trade. That is the one most important thing that I can tell you, is that do not ever force trades that are not there, because you will end up losing. If you're starting out, you shouldn't be playing lottos on Friday. You should be observing and trying to learn from it. And maybe after 3 months of learning and observing and taking notes, you're ready. This XPX trade that I'm taking right now, it didn't happen overnight. The AI I'm working out, it didn't happen overnight. I started trading SPX in January, but I've been preparing and studying SPX for 8 months prior. And I started working on the AI 6 months prior to the day when I first took my first trades. So it wasn't random. It wasn't one day I got up and decided, oh, I'm going to trade SPX. I never do that. Not just SPX, not just any other name. As you can see, like I never focus on what's running, what's hot. Oh, this company posted great numbers of earnings, I'm going to go and trade it. I never do that. I stick with what I know. And then gradually I expand. In the beginning of my trading journey, I was focused on 4 names, actually 5 names: FANGs, Facebook, Netflix, Amazon, Google, and Apple. I was only trading 5 names. And then I got more experience with it. I get to know more, and then I added more and more name to that list. And then I started studying NVIDIA. I studied NVIDIA for 2-3 months, 4 months. And then I added to my list where I would follow it and started taking trades in it. Same thing with all the other names that I usually trades, like Snow, MDB that I used to trade, AMD that I used to trade, Okta, Roku, all this name I used to trade, and it didn't happen overnight. I didn't randomly decide to trade it and then randomly decided to stop trading it. It's a pattern, it's a plan. So same thing with SPX. I've been studying for about 8 months now, and started working on the AI for about like 7 months now. And that's when, after studying and note taking, I decided to start taking trades. So the same things applies to lotto trading. Lotto trading is a totally different ballgame. You're competing against IV decay, theta decay. You're competing against all this other lotto traders that goes in with big position and quick can sway the market or that particular name in one way or the other. You're doing all this and you don't know any of that. So be very, very careful with lotto trades. But point being, be careful. Like I said, there are tons of sharks out there. If you're not careful, they will eat you up. The money that they make comes from the retail trader, like you and me, the trader who are ignorant, the trader who thinks that this is easy, the trader who thinks that, oh, I'll only have to make $500 a day to make $250,000 a year, or this or that number. Those are the traders that end up giving their money to these big sharks, and that's how they get rich. And retail trader, 90% of the retail trader fails because they did not take time to learn the game. They think it's easy. Oh, I posted the picture the other day. People like those people, those are the one end up giving their lunch money to the big shark, big bad bullies. So be careful, that's all. Anyway, so that was the TradeLog review. Let's go back to quickly, we're going to do a quick technical analysis. If you guys have any questions, feel free to ask me right now. All right, let's get started. So one of the questions that I cannot cover, that's a different topic, Ruben. But what I can tell you quickly is that strike price depends on what I see on the screen in terms of IV and in terms of a range, and also in terms of delta. We'll talk about it in a little bit. So SPX, we saw this big, nice jump in the SPX. Now this resistance where it failed on Thursday, it came, that 4,200 resistance was a strong resistance before, excuse me, and that's where it failed and pulled back last time when it was at this level. So that was going to provide a strong support. So going into next week, that 4,200 level is going to be my focus going into next week. And now on Friday, it tried to bounce and then pretty much sold off the entire day, managed to hold the levels 41.25 and then bounce back up. Now that 41.25 was the level where 41.20 pretty much was the level where it found the resistance before. So that acted as a support this time around. So going into next week, what I'm looking for is that 4,200 level break for any move on the upside, and I'll turn super bullish on it, because once it breaks over that, there is no real resistance until I would say 42.57, 42.70, and then almost 4,300. So, but those are minor resistance, as you can see. There's like 1 day resistance, like intraday resistance, nothing major. So for when you're looking at the yearly chart, you want to look at the levels that has been tested like time and time again. For example, this 3,800 level, it wasn't intraday. This level held like for 2 weeks in a row. So that's a very important level. Same thing here, this level of 4,100, 1, 2, about, well, like almost 3, 4, like it has been tested like many times. And it's the same thing here, this level of 4,200, 1, 2, 3. If I go back, I would see it more as well, right around this here, right here. See, that's the level right here. And so the point is, it's been tested many times, whereas all this levels that I've just mentioned, these are the intraday levels, right? It's important to watch intraday, but when you're talking about like the real resistance like this, where the entire market comes together, like all the bulls comes together and try to hold it, it's level that like this. These are the big important levels. 4,200 is one of them. So once it moves over 4,200, it's very highly likely that it will continue to move up. So that's the big level I'm watching. On the downside, 4,100, obviously big level, as you can see, tested many times. If it breaks below 4,100, I'm going to turn bearish and start focusing on the downside moves. There is a little, there's a small, not that one, trend right here, as you can see. So also if it breaks below this trend, that I'll turn bearish. If it holds on to this trend, there is a possibility that it can continue to move higher. So keep an eye on it, and let's see what happens. Apple, another monster move. Apple is moving. Apple posted the worst earning in the last 20 years or so, and it was still green on the day, and it was still moving higher. That shows you how powerful that name is. And just by looking at the stocks and comparing it to other names, you can see how strong this name is and how strong the rallies are. These are like multi-day, multi-week rallies, sometimes even multi-month rallies where it continue to move up and don't let up at all. So this is one of those rallies where it's moving for about since like entire month of January. It's just pretty much just moving up. So I'm very bullish on Apple. I don't trade Apple as much because the premiums are moves just so slowly. But when it loses, it changes the direction. Those same premiums lose value quite fast. So that is the reason I don't usually trade Apple. But if you, there are many people in the group that trades Apple successfully. So that's the level I will be watching right here. I'm going to change this one and put it a little higher. There we go. So that's the level I'm watching now, 157, pretty much 157.50 on the upside. And then on the downside, the level that I will be watching is right here, which is 152. So if it breaks below 152 going into next week, I will turn bearish on it. If it starts to move over 157.50, then I'll turn bullish on it. It will be interesting to see where it goes from this point on, because 100-day, 50-day, 100-day, and 200-day SMAs are all pretty much flattening out. As you can see, 50 days starting to curl back a little bit up. 100 days about to flat out. 200-day about to flat out as well. This 200-day SMA right here at 148 can also provide very strong support for Apple, so keep that in mind. But it is possible that we see a little bit of pullback, a little bit more consolidation, and it continues to move higher. If it breaks below this 200-day SMA, though, every time it has done that, it continued to pull back down. So this one, when it did it, it continued to pull back down, try to move over it, failed to go over, pulled back down, try to go over it again, failed, pulled back down. And this time around, it finally crossed over it. So Apple is over all three main SMAs, and that is a very bullish sign. So as long as hold above this SMA, you can continue to take calls in it. It's a bullish sign, and I'll stay bullish. Amazon, 50-day SMA finally moving up, 100 days still down, 200 days strongly down. It failed at 200-day SMA, tried to go over it, failed, pulled back big time, about 9% on Friday. So now this 100-day SMA is the level I'll be watching going into next week, which is 101. If it breaks below 100, I am firmly bearish in it, and I will start taking puts until it gets to 50-day SMA. And these are the level on my screen. Those are the level that I'll be watching for Amazon. Google, over 50-day. 50 days finally curling back up. It held this support, trying to bounce, stayed a little bit choppy in this area between 96 to 100. Finally moved over on Thursday and then pulling back on Friday. Now it will be important to see how it behaves around this level of 102.50. If it breaks below that, 100 can come, we'll break below 100, and we can see it go back and test this 100-day SMA here, break below that, and it continues to move lower. I am at the time, I'm pretty neutral in Google, so I don't know what's going to happen. I'm just watching the levels in it, and we'll see what happens in Google. If it manages to go over this 108 level right here, then I will turn firmly bullish in it, at least until it goes back to about 111. Tesla, strong uptrend, continue to move higher. Try to break over this 199 and then 197 level. It's trying to break over this range. As you can see, that's where it failed before. At the same level, try to break higher, failed, and pull back. I could see something similar happening if it doesn't break over that level on Monday. If it failed to break over this strong resistance of 199, expect a pullback to this trend line. Now that trend line will come in around 165, so that's a very nice pullback. A lot of support though in between. So this 183, strong support for past 2 days, break below that. This 178 level could also provide strong support for it. Break below that, there is no real support until like about 165, 164 area. So keep an eye on Tesla. A lot of good opportunities are coming, especially for Tesla bull. I would say wait for a pullback. This is a very steep uptrend. Sooner or later, that pullback is going to come. Now, 50-day SMA is pretty much flattening out. 100-day, 200 is still firmly down. This big resistance, if you're planning to take calls in Tesla, wait until it gets past this resistance, or wait for the pullback to trend line, or at least until this 178 level before considering calls in Tesla. puts below 178 can possible to 165 or this trend line again. It is below 100-day SMA. It is having trouble going past it, so just keep on watching it. NVIDIA, another name with a strong uptrend, as you can see, failed at 220, going to provide strong support bodies, but look at how steep this trend line is. So what would happen once it breaks it? It cannot possibly continue this momentum for another month or so. So there is going to be pullback. So when taking calls in NVIDIA, I'm going to be very careful. Look for like quick in and out trade. 50-day SMA though is moving strongly up. It is over all three SMA, which is a very bullish side. 100-day curling up, 200-day flattening out. So overall picture is very bullish in NVIDIA, but because of this step up trend, I would be very careful. Wait for it to pull back a little, wait for it to consolidate sideways a little before going in with more conviction. So that's NVIDIA. Meta, another name. It was moving nicely up on earning though, it just flew. Failed here at about 198 level, 197.50 twice in last 2 days. Holding this 182 support, 183 support for quite well. Now, what would happen? That 183 was the resistance back in August. 183 was resistance again back in July. 183-ish was support level back in May. Again, so this is a very important range. I would say about 183 to 185 is a very important range for Facebook. Now, Meta, sorry, there is no more Facebook. But if it breaks below this, wait for it to break below 180. If it breaks below 180, it is going to come back down. It is going to pull back to 173. Break below that, it can pull back all the way to 160. It is possible. On the upside though, if it breaks above 200, I would turn very bullish in it. It is over all three SMAs finally, 50-day firmly up, 100, 200 days flattening out. So there's a lot of possibilities here that this can go. But this level of 183 and below that, this 173 level is very important. This can provide a launch for Meta to move even higher, fail to hold this level, and it can pull back. So just keep on watching it, what happens. I will be following it very closely for possible trades. Netflix, nice move off of lows in the beginning of January, moved up, failed again. Look where it failed, like 264, like 264 to 65 range. Failed twice, Friday, Thursday, again back in December, again back in September. It did try to break higher again in September, failed at 160, 267, pull back up. That's the same level it failed many times before. So this range right here between 160, 264 and 267 is very important. If it manages to break over right here, I would say about 160, 269, then I would turn bullish in it. Until that point on, I'm going to be very careful and take it a day at a time. It is over all three SMAs finally. 50 days moving up, 100-day, 200 days flattening out. Support on the downside, 256. Break below that, this 200-day SMA could provide good support at 254. Break below that, 250 is the next support. Break below that, we are back in this range between 240 to 250, and it could get choppy around that range. So watch it, watch those levels, and that's the trade plan for going into next week for Microsoft. And Netflix moving up nicely. It is still an uptrend. It has been moving, as you can see, 50-day, 100-day, firmly up all the way since September. It's continued to move up. This is Netflix, very strong uptrend. 100-day, a 200-day is finally flattening out. It is a nice uptrend. So I'm very bullish on Netflix. But what I do want to see it pull back to either 257 level, 256, 257 area, or test this trend line again before launching up on another uptrend. Break below this trend line, I would be out until it tests this 200-day, 50-day SMA. Break below 313. Will that happen in a week? Probably not. But so this is the game plan going into next week for at least watch this trend line, pull back to it. I'll turn very bullish in it for another launch on the upside. Break below that. I would put my stop loss a little bit below that, get out, look for trades on the downside. That is the game plan for Netflix. And that's all I wanted to cover today. If you guys have any questions, feel free to answer. Let me answer, Ruben, let me answer your questions really quickly. So the options trade, let's say, let's take a look at one of the trades that did work out on Friday. And that was, for example, Meta 190C, 195C. So let's go back to Meta and change this to 5-minute. Right, and this was on 3rd. So right here, and the Meta trade that we posted was posted about 6:40 a.m. So I don't 6:40. When was 6:40? I think it's 14:40. Yeah, I would say that. So somewhere around that, right? So let's zoom in a little bit more. Now, what I was looking at when I'm trying to figure out my strike price. So figuring out strike price, you need to know the stock very, very well. And why is that? It's because that's how you know the range of the stock. One of the major benefit of trading and sticking to the name that you know and have studied for extensive period of time is because you come to know the potential of that particular name. How much higher can it go in a day? What is the potential? So if I'm trading, for example, Amazon or Google, compared to Netflix, Amazon, Google making $10 move is very, very rare. Whereas Netflix making $10 move is not that rare. I know that because I've been trading Amazon, Netflix, Google for a long period of time. So I know that inside out. You need to know that range, what is possible, because when you're selecting strike price, one of the main questions you need to ask is, how many days do I have left until the strike price? So for example, the expiration date. So for example, it's Monday and your expiration day is Friday, you have a whole week, right? So, and your stock is moving continuously up. So at that point, you can select if for example, it's Monday, right? Let's just imagine this is Monday. And I come in on Monday, what I'm looking for at a daily chart is that, okay, Netflix is very, very high. So it made this really nice move. My game plan going into Netflix, I'm getting confused. Meta has been really nice move, good earnings, holding levels. It's Monday. I know how it's moving. It's an uptrend. So come Monday, I'm right here, and I'm looking at my plan is that if it moves over this SMA, sorry, why is it? Do I reset chart? There we go. So I come in on Monday and I'm like, okay, my game plan for Facebook is that if it moves over, say 190, then I'm going to get into Meta calls. If it pulls back to 182.75, I'm going to get into and hold. I'm going to get into Meta calls. Now it does pull back to 182. Now I'm thinking, okay, what should my strike price be? Now Meta has been moving nicely. It did pull back. Now, when I'm selecting it, I'm like, okay, 195, it's a good price. Can Meta move to 195 in a week, given the current trade? That is the question I'm asking. Yes, no, depending on your answer, depending on what you know about it, you can pick your strike price. Now I'm looking at the chart, I'm like, okay, it went from 184 to almost 196, 195 in a day. So in a week, it's totally possible. So I'm like, okay, I can afford to take 195. So I'm going to take 195. If your account is bigger, you want to be a little bit safer, you would do 190. That's fine too. Now, this is Friday. On Friday, it came in, it pulled back, it started to move higher. So about 640, like when it moved over this first green candle and it was at 188, I asked myself how high Meta can go in a day. I'm looking at the previous day at the same level, which was 188.91, so 189 level. It moved to 195, 190, almost 197 in a matter of 2 hours. Is it possible for Meta to go to 195? Absolutely. So that's the strike price I chose. Could I have chosen 200? Absolutely. But in my mind, 197, it's going to fail. It may take a little bit longer to get to 200. It's quite a bit. It's like $10 move. Can it move $10 after already being up $5 or $4 or $3 in the morning? Is it possible? Yes. Is it possible in one day? Because it's 1 day expiration calls. It's possible, but it's stretching a little bit, right? So I'm like, okay, I'm gonna go with the safer, which is 195, because the resistance doesn't come until almost 197. So I'm gonna stick with 195, and that's why I picked the 195 strike price. So there is a lot of layers to it. How far is the strike price? What is the range? I could have chose like, and sometimes that's where it gets confusing because you're thinking that 200 is more cheaper than 195, but what you fail to realize that 200 is riskier than 195 because there's harder for Facebook to go to 200 in a day than it is for 195. So by paying a little bit extra premium, you are safeguarding your profit and you're making sure that you have higher probability of being successful in that trade. Right. So I could have chose 240, 205. And if we were to fly to 205, that would have been like 1,000% rate increase in my premiums, and I would have been able to make a lot of money. But probability of that happening is very, very low. But probability of Facebook going to 195, very, very high because it has already done that a day before. So many layers to it. If the same things I would choose on Monday, I probably would have chose $200. One, because it's cheaper. Two, because I have 5 days left. So it is possible for Facebook, for Meta to have that time to go over this resistance and my trade to work out. So there is no one way to determine what strike price that I would go with, right? And now if you take the same logic, go to, for example, Amazon. For Amazon, I'm not going to choose 111 or 110 because for Amazon to move from 105 to 110, that's a $5 move. And it's very hard for Amazon to move $5, especially when things are not in favor. It's in favor. On a very good day, it moves like about 109 to 103, 113.15. That's like $4.50 move on a very good day. This is the entire move that it did in a day. So for me to expect Amazon to move $5 in a day is a stretch. So at that point, I would keep it close to like maybe $2 move or $3 move because I know that is very, very possible. So it's all about probability. You need to ask yourself, the strike price that I'm choosing, how probable it is for that name to go to that strike price in the given time frame. Once you answer that, you will know which strike price to pick. Hope that answered your question.
Oh yeah, I did. Thank you so much, and I'll probably take a look at it.
All right, awesome. So that's all I wanted to discuss with you guys. I hope this was informative and you guys learned a thing or two. As always, feel free to post your questions even after the webinar in the chat room, and we will be more than happy to answer any and all your questions. Thank you again for joining on this fine Sunday. I will see you all tomorrow, and let's see what we can do with it.